It's a little ironic, but the things that create a booming economy are the same things that create a broke American. And what we're seeing happen today is more and more Americans are starting to go broke. Our economy runs on spending. When you spend all of your money, the economy booms. When you go into debt to spend more money, the economy booms even more. The more money you spend, the richer somebody else makes. Well, today, we're starting to see a shift in the way people can spend. We recently got some new economic data that says that consumers are strong, but that consumer spending is starting to slow. Let me actually take it one step further and read you directly from what Jamie Dimon, who is the CEO of JP Morgan Chase Bank, had to say. The consumer is in good shape. They are spending down their excess cash. This is why we have booms and busts in our economy. Our economy runs on spending, but then beyond that, we live in a credit-based economy, which means people have the ability to spend not just based off of how much money you earn, but based off of how much credit you qualify for. If you make $50,000 a year from your job and there was no credit, the maximum amount of money that you could spend is $50,000, which means the most you could stimulate the economy is $50,000. If you only spent $10,000 out of your $50,000, that might be good for you because now you saved that 40 grand. You might be investing that 40 grand to build your own wealth, but that's not so good for the economy because that means Chipotle is saying, hey, give us some of your money. Gucci is saying, give us some of your money. Apple's saying, don't you want to buy some of our AirPods? But now if you flip things around and you spend $40,000 and save $10,000, now Gucci's saying, hey, thanks for buying our handbag. You want a belt too? Apple's happier because he bought their AirPods. Maybe you want to buy their phone too. Chipotle is saying, hey, you want to buy some more double guac? But then if you take it one step further, where now you make $50,000, but you can qualify for an additional $25,000 worth of debt. Maybe it's a line of credit. Maybe it's a home equity line of credit. Maybe it's a credit card. Well, now you could spend all $75,000 and now you're really stimulating the economy because now you are spending money like crazy. You're walking into the Gucci store, you're buying the handbag, you're buying the belt, you're buying the hat too. You go into Chipotle and you say, you know what? Let me get the double guac and the double meat. Actually, you know what? Give me a side tort too because now Chipotle is charging for their side torts as well. And now you're really stimulating the economy. This is where now you have to understand as a consumer, as an investor, as a person, how this economic system works because our economic system runs on spending, but also how our economic system is changing because we're seeing changes happen right now. And these changes can also create more opportunities. Now, I also want to remind you that on August 15th this year, it is going to be the 52nd anniversary of our dollar being taken off of the gold standard. And because of that, I'm hosting my first ever investor summit. It's completely free. But in this summit, I'm going to be talking about, number one, how the economy and money has changed over the years, how we're living in this new economy today, and then number two, how you can capitalize on opportunities in this new economy because the reality is the people that understand what's happening today are gonna be able to create and capitalize on more opportunities than ever before, but the only people that will be able to capitalize on these opportunities are the people that, number one, understand what's happening and then have the ability to actually capitalize on it. So that's what I'm going to be talking about in this Investor Summit. It's completely free. It's going to be a ton of value. So if you want to join, I got the link to how you can join for free down in the description below. But I should also remind you or kind of give you a notice that there is a limited number of people that can join because the software just has a limited number of people that can register and join. So if you want to join, please make sure you register and then actually join the call on time. That way you don't get kicked off by the software. So now the natural next question is, why are consumers slowing? Now, obviously we know the inflation part, but there's two parts that aren't so well understood. Number one is that Americans have less ability to save. And number two is that Americans are tapping into their savings and these savings are being depleted. Let's start by taking a look at how much money Americans save. This data is from the Federal Reserve Bank, and what you'll see is that back in May of 2019, Americans were saving more than 8.5% of their income, which already wasn't enough. But if you fast forward to May of 2023, the average American was saving less than 5% of their income. Why are Americans saving so much less of their income? Well, probably due to the fact that we've had all this high inflation, making rent and your housing costs more expensive, making groceries more expensive, making vacations more expensive. So because of the higher cost of living, people have less ability to save. This brings us to the second factor, which is people now having to dig into their savings to continue funding all of their spending. Let me actually read you this excerpt from CNBC. This article was published in February 2023, and the title is "Amid Persistent Inflation, 54% of Americans are using savings to pay for everyday expenses." And then if you scroll down, it says to make ends meet. 27% of Americans said they've had to take money out of savings, and more than half, or 54% of Americans, said that they've used that money to pay for everyday expenses such as groceries and rent. So on one hand, we have reports saying that consumer spending is strong, consumers are resilient, consumers are keeping the economy booming, but consumer spending is slowing. So the economy is strong because consumers are spending. But the red flag here is that consumer spending is slowing because consumers are ultimately what drive our economy. If people don't spend, the economy doesn't grow. If people are spending, the economy is growing. But ironically, when people spend, then you're going to hit a breaking point where people have to save, because when you overspend, eventually you hit a breaking point. Eventually, you dig all the way through your savings. Eventually, you max out your credit cards. And when that happens, now instead of spending, you have to start saving. Instead of spending, you have to pay down your credit card debt. Instead of spending, you have to start building your savings. Now, these things, the building the savings and paying down your debt, is good for your wealth, but it's not so good for the economy. And this is where now you want to pay attention to this, because why is consumer spending slowing? Well, obviously, inflation is still a problem, but because of this high inflation, number one, Americans are saving less of their money. They have less ability to put money aside. And then number two, more and more Americans are now having to dig into their savings or go into debt to fund everyday expenses. Because now, when you see the higher cost of living, when you go into a restaurant, you see the higher cost of your bills. You go on a vacation, you have the higher cost of the flight. You have to go to the hotel, you have to pay more money for the hotel. Either you're going to say, you know what, we'll just put it on the credit card. I don't want to sacrifice this lifestyle that we've had. I've been liking going to these restaurants every Friday night. I don't want to stop doing that. Or you're going to say, something's going on here. The cost of living is growing very fast. I don't know if we can keep affording living this type of lifestyle. Maybe we should cut back. And for the average person, cutting back is way more difficult than just putting it on your credit card or digging it into your savings. And that's what we're seeing happen right now. Consumer spending is slowing because some people are digging deeper into their savings or they're tapping out on their credit cards. And there's only so much further that you can go. Once that excess cash, the excess savings, the excess debt ability goes away, that's when the consumer spending also goes away. And this is where a lot of people say, but what do you mean excess cash? How do people still have excess cash? How do businesses still have excess cash? This has been a year and a half since the pandemic really stopped. How is there still excess cash? And the thing that's difficult for a lot of people to grasp is the real amount of money that was created to stimulate our economy. There was a statistic that was put out by NASDAQ, which said that we spent more money stimulating our economy in 2020 and 2021 than we spent fueling all of World War II, even after adjusting the war numbers for inflation. So yes, we're seeing big shifts happen in our economy right now. They might not be showing up in the markets or in asset prices, but there are shifts happening in the economy. Some people are noticing, but these are gradual shifts. And that's what makes them so unique, because everybody expects changes in the economy to be drastic and dramatic. But we're starting to see this slow, gradual slowdown in spending. And if spending continues to slow down, eventually that's going to hit businesses' revenues. Because if people have less ability to spend, that means less people are going to go to Chipotle, less people are going to go to Gucci, less people are going to go to Amazon. And if less people are going to be shopping, that means businesses are making less revenues. And that's at a time where costs have risen. Why have they risen? Because of inflation. But in addition to that, we also have huge amounts of debts out there, corporate debts. And these corporate debts are not 30-year fixed rate mortgages. Remember, corporations loaded up on debt in 2020 and 2021. And these are many times adjustable rate debts, where every 3 to 5 years, these debts start to readjust. And what we've been seeing is that in the coming 24 months, we have a lot of corporate debt, a lot of real estate debt that's going to be readjusting. And when it readjusts, this debt is going to change depending on where interest rates are. And interest rates are significantly higher today than where they were 2 years ago, 3 years ago. which means if nothing changes on the interest rate side, that means corporations are already going to be facing higher prices because of inflation, but then number two, they're going to be facing higher costs because of the debts. And if consumer spending continues to slow down because people keep racking up the credit card debt and they dig out of their savings, then there's going to be less ability for people to spend. That means lower revenues, higher costs. And this is where it becomes so crucial and important for you to understand this. That way you can capitalize on opportunities that might come your way. But in order for you to capitalize on these opportunities, that means number one, you have to understand what's happening. Number two, you have to be financially educated. You have to know how to invest. You have to know how to find the opportunities. You have to know how to invest in stocks, how to find good stocks, how to invest in real estate, how to find good investment properties, how to invest in businesses. And then number three is you have to be prepared. Because you can see the greatest investment opportunity in the world, but if you don't have any money to actually capitalize on it, it doesn't do you any good. That means right now, you got to get your money right. 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. And that's why it's so important right now for you to get financially smart and understand what's happening. Because while we're not seeing this drastic shift in the economy today, what we are seeing is this gradual slowdown in spending. And if that continues, that's going to have more and more drastic effects on our economy. It looks like home prices are finally dropping. Let me read you the title of this article from Reuters. U.S. existing home sales edge up, but prices drop by the most since 2011. The article goes on to say that the median sales price was $396,100, which is a 3.1%